I was plowing through all the latest books written by people who had done venture capital funds themselves, and also people who were active angel investors. And one of the things I noted was that many of them, they commented on where did they find the best companies. And consistently they said the best companies get referred. Then I went out to look at the websites of venture capital funds, and I noted that in many of the funds, there's not a telephone number, there's not an email address. There's no way you can contact these guys. So how does that work? Of course, it works if they get most of their investment ideas through friends and network. So that's what I read, and what I can say is that these guys were right. So the best investments tend to be the ones that come to you preferred. But there are really three different ways for a professional investor to get cases in, to find your investments. The first one is that they come to you uninvited. I mean, of course, you kind of encourage that, but they come to you even though you don't know them. In some industries, you would call that the walk-ins. The second one is the referrals. They come recommended. And the third one is somebody who are not looking for money, but you think they should be looking for money and they should be looking for a partner. So these ones are typically companies that are doing quite fine. They're probably profitable, but they're not growing as fast as they might. So it's like you see a car, it's a good car, it's going well, but you just stop it and say, sorry, I have been looking at your car, I think you could drive 4 times as fast. Would you like us to join you on the journey? And then we step on it. And some of them say yes. And we've done some of that, and it's actually been really good. But the most important for us, and apparently for everybody else, is network. And because of that, many venture funds, they have structures for that. I have already previously touched upon these sidecars. So you have a fund that most of your investors are big family offices and pension funds and so on. But then you make a little part of the fund available for entrepreneurs. And instead of having a minimum investments of perhaps $5 million or $20 million, for these guys, it might be down to $100,000 or $200,000. The reason being you want them because you want them to be enthusiastic about your fund. Because then you have better access to them and they see what you invest in, so they have that information, they know where you are, they know what you are enthusiastic about, what you are exposed to, and then they will contact you and say, look at this, look at that. And they like to refer good cases to us, and they don't like to refer bad cases because it's a little bit like referrals are like currency. I know that you refer because you're a nice person. But it's also, if you keep helping your friends and say, I saw this, which might be useful for you, I saw that, which might be useful for you, you get a good reputation as a helpful person and a person who is worth listening to. What do you think the outcome will that be? Of that would be? The outcome will be, after a while, that people refer stuff back. And sometimes people will refer to such a person something good, and then the person says, it's not for me, but it is good, so I refer it on. So you have this network of eyes and ears of people who have pattern recognition, people who are talented, people who can, to a high degree, tell whether something is promising or it's bullshit or it's not so hot or whatever. But let's now take how a professional investor that has a flow of deal offers operate. Who can that be? It can be an incubator. An incubator is like a nursing home for young startups. It can be an accelerator, which is pretty much the same, just with a different structure. Or it can be a venture capital fund. It can also be a group of angel investors. But the typical flow is this, that you get something like to the tune of 1,000 different cases per year. Sometimes it's more. For some of them, the bigger ones and the older ones and the more reputable ones, it might be more, it might be 2,000. But let's say 1,000 is quite common, 1,000 cases. What will you do? So out of 1,000, there might be 500 that you can say right away, this is not for us. It's not for us because it's not a growth startup. This is a lifestyle startup. This is something where the founder needs money, but the founder has no intention whatsoever of ever selling it because it's his job or her job. So how can I get my money out? And also, there doesn't seem to be any plan to grow aggressively. I want my money back 10 times. So how do I get my money back 10 times in, say, 5 years if you're not growing aggressively? So this is not a growth startup. This is a lifestyle startup. It might be great, admirable, clever, whatever. It's not for us. The other ones that you decline, you decline them in a nice way, of course, and you have to do that. But the ones that were clearly not professional. Now, if somebody writes to me full of spelling errors, I just know that if they don't even bother making the very first contact remotely professional, I mean, then there's no reason at all to assume that anything else is professional. So the ones that approach it like that, you just say, no thanks, it's not for us. Then there are the ones that are in an area you don't understand. But there can be many other reasons. It's too late stage, or it's something where they don't need our help. We prefer companies that need our help because we want to build up a reputation as a helpful company. Anyway, so you have this funnel, and it goes from 1,000 maybe down to 500 because the 500 you have declined right away. So what happens with the remaining 500? Well, you spend time on it. You look at the pitch decks in more detail. You have, like almost any fund I know, they have a partner meeting every week where they go through what has come in this week, what do we think about it. During that meeting, they also talk about other cases that they are working on. But at that meeting, typically you reject a number of cases for different reasons. But some of them survive this process, and then you get from, say, 500 down to 200. With the 200, so now it's 20%. The 200, you want to hear more. The pitch deck seems intriguing, good, fine. There's a lot to like. Now you want to talk with them. So you can either have a meeting with them, or you can have something like a Skype call or Zoom call or something like that. Reason that Skype call can be quite nice is that you understand their situation. You understand that they're busy, they're overworked, they need to see a lot of investors, and if they have to travel across the country to have 20 minutes meeting with you, you don't want to waste their time if it's not at all relevant. So mainly for their sake, you try to make the first contact something super easy for them. But then if that goes well, then there will be a physical meeting. And at that point, maybe we are from 1,000 down to, say, 100 companies. So 100 companies where you actually spend some time, you have discussions, you look at their products. You might say, can we come and see you and your facilities? You sniff around, try to get a sense of it. Then it might be that out of those 100, there's 20 where you say, we think we'd like to invest. Some of them not immediately. Some of them, they go into this holding pattern where you want to do live due diligence. So let me explain what live due diligence is. Live due diligence is that you are interested, but not convinced, or it's not a good time for you. So you say you'd like to have contact, you would like to meet them regularly, you would like to receive a flow of information for them because you're now following them. And you're following them to see how they handle the challenges out there in the market, how they handle internal challenges, to which degree they're able to meet their own milestones and so on. So you get a good feel for them. But in any case, out of 1,000 initial cases, perhaps 20 become potential investments in a serious way. And then what happens is you decide to go into some sort of due diligence. Now, due diligence is very costly in terms of internal time, and because you typically hire lawyers, a law firm, to go through all their documentation. It can easily cost $100,000 or $150,000 to do due diligence on one startup. So you don't want to do that unless you have agreement on the investment terms. So before you start the due diligence, you present them a term sheet. They look at the term sheet, it goes a little bit forth and back, and if you can reach an agreement on that, then you start the due diligence. Now, in our case, in half of the due diligence processes, we back up somewhere in the process because we say we found something we don't like. So when you take this whole funnel and look at what becomes investments in the end, it's something for many funds is something like 1 to 2% of the initial cases that actually become investments. And this is the case for venture capital funds, for accelerators, for incubators, and for groups of angel investors also. Angel investors very often they come in early, and then they have very good relationship with venture investors that come in later, and then these people talk together a lot, and so when the angel investors have a really good case, they tell that to the later stage venture investors, and so they come in and invest after them and so on. Of course, there are situations where there is competition. If you have a very hot investment, and anybody in their right mind would love to get in on that, then you can get a battle between venture capital funds, for instance. Sometimes you get what you call a term sheet battle, and this is where everybody wants to get in, and instead of coming with very thick 20-page complicated term sheets, they come with something on one page, which is really compelling. Or even they say, can I meet you at a bar? Say that to the founder of a company. You meet at a bar, say, listen, we've looked at a company, we'd like to come in, valuations $50 million, very simple terms, you take it. So they make it really simple if they really want to get in, but this is really an exception.
Do you speak future?